Hey, Fundi community, it's been a busy time at Fundi Finance with the team working on the Fundi Real Estate Funding Portal update. Good progress has been made, and a prototype layout of the portal will be updated to the website this week. While some of the team have been busy with the website design side of the roadmap, other team members have been designing the core mechanics of how the system will work and comply with regulations. So let's waste no time and make haste. What is a crowdfunding portal? Crowdfunding is a way to raise money from a large number of people. Large groups of people pool together small individual investments to provide the capital needed for a company or project. Individuals, charities, or companies can create a campaign for specific causes, and anyone can contribute. Crowdfunding platforms often use a crowd note, which is a financial tool based on a debt securities asset. How will Fundi Finance portal work? The Fundi Finance real estate portal will work via a secure, P2P, transaction on the Binance Smart Chain. The trade is decentralized and between investor and fundraiser directly. Only the autonomous smart contract interacts with verification of data via the signature of each party and predefined factors within the smart contract. This enables a private transaction using the user's SSI and an already verified wallet address linked to the wallet address of a user's membership subscription. AML regulation requires fundraisers and investors to subscribe to a membership of the Fundi platform. Membership details and fees will depend on the level of investor or real estate project the user is classed. The portal provides a direct link between investors and fundraisers via blockchain. Transaction fees of 0.3% for investors and 1.5% of the total raise for fundraisers are mandatory during the raising process. For a raise to complete, it must raise the total amount of funds predefined in the smart contract. If funds are not raised, investors receive a full refund minus any gas fees. Regulation. This has been a big area with a lot of focus for the team. We are currently fine-tuning the website to the steps required by the Georgian Finance Authority and FCA framework regarding AML and other regulations. Another coming step is seeking FCA approval to provide services in the UK. These steps will be multiplied out to other jurisdictions step by step. Securities regulations concerning equity and debt assets have been the team's main focus, also the individuals who can invest in such activities and under what suitable structure. The Fundi team is taking a step-by-step approach to comply with regulations, and evolving with the traditional systems has been extremely exciting. Firstly, there is a vast difference between raising funds of equity and raising funds of debt. Though both assets are considered securities, debt is often exempt from the levels of regulation that equity requires. The Fundi subscription membership is one precaution designed to ensure the safety of investment funds to investors and fundraisers whilst complying with KYC and AML regulations. These are steps we are taking. Starting system will only offer debt-based investments, particularly making good use of financial notes such as debt notes, crowd note, promissory notes, construction loan notes, mini bonds, convertible note. All the above financial instruments are formal debt-based contracts used in traditional markets to raise funds, particularly real estate assets. Fundi Finance intends to provide services that will mint fundraisers' debt contracts to NFT, enabling an investor to verify and sign. Starting with the world of mini bonds. Non-transferable debt securities (NTDs), commonly referred to as mini bonds, are unlisted bonds typically issued by companies to retail investors in order to raise finance. As non-transferable securities, investors cannot sell their investment, which generally is held until maturity. The issuance of NTDs is, in general, not a regulated activity for the purposes of the Financial Services and Markets Act 2000 (FSMA), although the marketing of such products falls within the scope of the Financial Promotions Regime 1. The NTDs market emerged in 2009 as firms sought an alternative form of finance following a fall in bank lending to small and medium-sized enterprises after the financial crisis. This demand for capital was met by retail investors looking for a higher return on their savings in the low-rate post-crisis climate. Initially, NTDs was primarily issued by established consumer-facing businesses who used their offer to raise working capital and as a tool for encouraging company consumer engagement. With many issues offering additional benefits, such as access to free or discounted products, alongside a return on their investment. Mini bonds often yield higher returns for investors as they are riskier debt assets. A standard rule of thumb is that mini bonds should be 10% APR or higher in yield and be payable back usually within 12-18 months period, or as early as 90 to 180 days. Mini bonds are currently not regulated by the FCA and other regulatory authorities. However, a company offering financial services will be, and this means that AML and other regulations will still have to be followed.